Hey traders and investors, it's Serge Berger here. We had a real big rally in stocks on the 1st of March to start a fresh month, and it's gotten a lot of further shorts and bears squeezed, which is quite traditional what you tend to see in what remains a bear market in equities as far as I'm concerned. Again, as a base case, I do want to remind you that I do think that ultimately at some point in 2016 we will see a mean reversion move back toward that 1600 area in the S&P after a major topping formation that we are seeing a lack of breadth, economic slowdown, corporate growth, profits, and both top and bottom line have been decelerating. So there's a lot of reason to think why we're going to see a mean reversion back to where the breakout to the fresh secular bull market started around 1600, give or take, let's call it 100 handles, or well, let's call it give or take 50 handles or 100 handles on the downside. But I do think 1600 is more or less the least we'll probably get to on the downside. So keeping that in mind, my base case remains here that we need to be a seller of stocks on rallies and a buyer of bonds until this sort of resolves itself. And if we zoom in a little bit closer, you will see that on the S&P 500, which we can use here as a sort of broad measurement for stock, we're finally coming into an area that I've been highlighting for some time that I think is actually better resistance, and it's made up somewhere between 1980 and about the 2000 area where we're starting to get better resistance. What used to be support may now become resistance. The 50-day moving average, that yellow line here, once again served very useless as it tends to be for the S&P 500. The MACD, which is just a basic momentum oscillator we use, is finally starting to get into some sort of overbought levels, which that too is a fairly typical sign. What you tend to see in bear markets, you tend to see stocks get into overbought conditions before they end up being better sells. So it really serves us well to be patient here and sell the rallies that get overbought, not just a little bit, but quite overbought, and then start shorting stocks from there. So the S&P finally coming into an area of resistance. I do think we still need bearish confirmation here as well, but we're starting to see this play out more and more in various pockets of the market. Conversely, we have bonds, right? And bonds, of course, the inverse of what stocks did on March 1st, which is basically trade lower, and you're starting to see that the bonds here remain in what I would refer to as an intermediate term uptrend. We had a real nice breakout take place here in the early part of January. You can draw these lines anywhere you want. We had a nice breakout and back into, I think, an intermediate term uptrend. We're now finally coming into better technical support here. You can draw these lines in many different ways as well, but technically, this high here that we had last August at the spike where the stock market basically fell apart is now an interesting spot as well, at least as a mean reversion move for the bonds to have fallen to. So here too, risk reward, or reward to risk I should say, is getting better again to buy bonds. So as a theme, I think tactically active investors and traders for that matter should be better positioned by selling into deeply overbought conditions on the equity side, and then conversely do the opposite in bonds and actually buy the TLT longer dated bond ETF. So I hope that makes sense. Folks, please do like my video. That's how I move up in the YouTube ranks. Subscribe to my channel. And as always, I'll see you guys in the next video.